Hello and welcome to the progress. In last session, we saw about the scenario of the bank in which if the bank is not having the cash, then how it is going to borrow money from RBI, either by repo, MSF or by using the bank rate. And in this video, we are going to see about the other situation of the bank in which bank is having excess amount of cash and what it going to do with this excess cash. As a person, if you are having excess cash in your hand, then what you will do? We will try to invest this excess cash and we will, with the interest of this excess cash, we will try to earn the profit. The same thing the bank also tries to do. When the bank is having excess cash in the hand, then it will deposit with the RBI either by using reverse repo tool or by using SDF or the standing deposit facility tool. So what is this reverse repo? As the name suggests, it is opposite to the repo. By repo, the bank is going to borrow money from the RBI. As a reverse to the repo, bank going to deposit money to the RBI or RBI going to borrow money from the bank. And what is SDF? We will see what is SDF and what is reverse repo. Suppose if the bank is having excess amount of cash, then what the RBI will do, the bank can deposit this excess cash with the RBI or bank can park this excess fund with the RBI. Since technically RBI is getting money from the bank, correct? Bank depositing with the RBI or RBI getting the money from the bank means the RBI has to keep certain collateral with the bank, correct? Because bank is providing money to the RBI, therefore RBI should provide certain security to the bank by pledging some collateral or the securities, and the RBI will be giving some repurchase agreement, that suppose for example after 1 week I will get back my government securities and I will give that money back to you. Like this RBI will promise to the bank. So it is similar to repo. Therefore, collateral has to be kept and repurchasing agreement has to be kept. But in the repo, these two things are kept by the bank with the RBI. But in the reverse repo, as a reverse to the repo, the RBI will keep the collateral with the bank and repurchase agreement with the bank. And after the maturity, the RBI will get back its collateral by paying the money liable to the bank. And for this, bank will be charging an interest rate like repo, but it is known as reverse repo rate. It is a technical term for the interest rate that is charged by the bank with the RBI. The term is reverse repo rate, and this reverse repo rate is always less than the repo rate. Repo rate is always greater than the reverse repo rate. Therefore, if the RBI is keeping collateral or RBI wants the money from the bank means the term is reverse repo, and the reverse repo interest rate is lesser compared to the repo rate. Then, what is this standing deposit facility? Consider the situation of demonetization. During the demonetization, all of us deposited all the 500 rupees or 1000 rupees currency with the banking system. Therefore, banking system flooded or flushed with huge amount of liquidity or huge amount of money supply. So to suck out this money supply, why to suck out this money supply? If there are large amount of money supply in the banking system means it may cause inflation. So to suck out this money supply from the banking system, RBI can use reverse repo. But under the reverse repo, RBI has to provide the collateral. But under the demonetization, there are huge amount of money supply in the system. To suck out all this money supply, the RBI is not having enough collateral to suck out this money supply from the banking system. Therefore, to overcome this, RBI came up with a new tool known as the Standing Deposit Facility. Under this SDF, the RBI can suck out or can borrow money from the bank, but there is no need of the RBI to provide collateral to the bank. Unlike the reverse repo in which the RBI has to pledge some collateral to the bank, but under SDF, the RBI is not having any liability to provide any collateral to the bank. And this kind of SDF has been recommended by the Urjit Patel Committee recommendation during 2014. And this tool is very useful during the demonetization kind of issue. That is the situation in which there is excess amount of liquidity or excess amount of money supply in the market or in the banking system. To control this SDF will be very useful. And this will allow the RBI to absorb the surplus fund without the collateral. So this is the concept with respect to the reverse repo or SDF or how the bank is going to deposit its excess cash with the RBI, or how the RBI going to borrow the money from this banking system. I hope the concept is clear to you. Thanks for being with me. Have a great day.